In the financial landscape of 2026, the era of zero-interest bank accounts is officially over. If your hard-earned cash is sitting in a traditional big bank savings account earning a measly 0.5%, you aren't just missing out, you are actively losing purchasing power to inflation every single day. Today, we're putting the two heavyweights of modern cash management into the ring for a title fight: high-yield savings accounts versus money market funds. By the end of this video, you will know exactly where to park your next $10,000 for maximum gain and safety. First, let's look at high-yield savings accounts, or HYSAs. These are primarily offered by online-only banks like Marcus by Goldman Sachs, Ally, or American Express. In early 2026, these accounts are typically paying between 4 and 4.5% APY. The primary advantage here is a concept called fixed peace of mind. Your deposits are FDIC insured up to $250,000 per institution. This means even if the bank disappears tomorrow, the government guarantees your principal. They offer instant liquidity, allowing you to move your money to a checking account and spend it almost immediately through an app. On the other side of the ring, we have money market funds. It is vital to understand that these are not bank accounts. They are specialized mutual funds managed by brokerage firms like Fidelity or Vanguard. These funds invest in very short-term, high-quality debt instruments, such as U.S. Treasury bills. In the current 2026 market, these funds are yielding between 4.8 and 5.2%. While they are not FDIC insured, they are protected by SIPC, which covers the insolvency of the brokerage. However, they have a one-day settlement period, known as T+1. This means if you sell your fund on Monday, you won't have the cash in your hand until Tuesday. But here's the secret sauce that most retail investors completely miss: tax efficiency. HYSA interest is considered ordinary income and is taxed at both the federal and state levels. However, certain money market funds, specifically Treasury-only funds, may be exempt from state and local taxes. If you live in a high-tax state like California, New Jersey, or New York, a 5% money market fund could actually put significantly more net cash in your pocket than a higher-yielding savings account because you aren't sharing those gains with your state governor. Let's look at the math with a $10,000 example. Over 1 year, in a 4.5% HYSA, you earn $450 in interest. In a 5.2% money market fund, you earn $520. While a $70 difference might seem small for 1 year, when you compound that over a decade or apply it to a $50,000 emergency fund, the gap grows into thousands of dollars. Furthermore, you must check the expense ratio on money market funds. While HYSAs are free, money market funds charge a small fee, usually around 0.1%, which is already baked into the 7-day yield you see advertised. So, how do you decide? Think of your cash in two buckets. Bucket 1 is your immediate emergency fund, 3 to 6 months of expenses. This belongs in an HYSA for the FDIC insurance and instant access. Bucket 2 is your opportunity fund, money for a house down payment, a future wedding, or a car. This money should be in a money market fund to capture that extra yield and state tax benefit. In 2026, wealth isn't just about how much you earn, but how much you keep. Don't let your cash sit idle. Subscribe to Compound Insights for more deep dives every Tuesday and Friday to ensure your money is working as hard as you do.